Okay, Chapter 13. Companies frequently invest excess funds in securities. And if management's intent is to hold on to them for longer than 12 months or an operating cycle, whichever is longer, then they're listed under the investments section of the classified balance sheet. Companies as well as individuals can invest in two basic types of securities, either debt in the form of bonds, treasury securities, convertible debt, or equity, which is primarily common in preferred stock. I mean, they list warrants and options and rights, but primarily common stock is what companies go out and buy. There's a multitude of reasons that they do that. One, to maybe earn some profit on some expected gains in price of a particular security. To park some excess funds that they may need for expansion down the road, and they want to make a higher rate of return than you can do by just putting it in a savings account or CD. They also commonly go out and buy interests in other companies if there is a vertical supply chain issue. So if I'm a manufacturer and I have an integral component to my manufacturing process that I absolutely have to guarantee delivery on, there's no better way than to go out and buy a significant portion of that supplier's common stock in order to get their attention. So there's a number of reasons. Microsoft back in the 90s bought a large block of Apple stock because Apple was doing very poorly at the time. This was before Steve Jobs returned to Apple and made it the company that it is today. And so Jobs and Bill Gates have always been rivals, bordering on a hatred of one another. And so Gates took great relish in buying a large chunk of Apple stock, which they both benefited greatly for. Apple got the influx of capital that they needed in order to go out and start innovating some additional products, the benefit of which some of you may own, the iPad, iPhone. And Microsoft got a stock that climbed significantly in value over the years. I don't know if they still own that block or if they've sold it off, but my point is there's a number of reasons that people buy equity stock in other companies. So these are just generally referred to as marketable securities, and we'll talk about the actual accounts for the names for that here in a second. So there are 3 levels under U.S. GAAP that we consider depending upon how much stock a company invests in. Generally, if you buy less than 20%, and I say generally, and I'll elaborate that in a second. If you buy less than 20% of another company's outstanding stock, it is a minority interest, a passive investment. You buy 18% of somebody, for the most part, you're not going to really be able to control the company. Now, having said that, if you went out and bought 19% of General Electric, yes, you would probably get a seat on the board of directors and be able to exert significant influence over the direction of GE. Because you would probably be the largest single shareholder in General Electric. But for the most part, U.S. GAAP has these nice little, we call them bright line thresholds. And the threshold for a passive investment is under 20%. And the reason that's important is because the accounting after you make the investment differs. whether you're below or above that 20% threshold. And I'll talk about what that difference is here in a second. If you're going to make a passive investment in either a debt or equity, there's three ways of doing it. One, you're going to hold the debt. This is for debt only, so you're buying a bond, whether it's municipal or corporate. You're buying a bond, and you're going to hold it until that bond matures, at which point you'll redeem it. So you're buying it for long-term investment purposes. And this is management's intent. So every time, either on an exam or in a problem in the back of the book, they're going to have to tell you what is management's intent when they make this investment. So that's the first one. You would put it into a held-to-maturity security account. The second one is a trading security. This is both debt and equity. If management's intent is to sell this investment short-term for a short-term gain, then it's a trading security. This is what is commonly done daily with banks, insurance companies, brokerage houses, people who have an active trading desk. They're constantly buying and selling stocks. Pension plans is another one that does this regularly. All right? So management's intent, once again, is that they're going to hold on to this just until they can get the price to go up and sell it and dump it. Different type of accounting. And then lastly, if it's not a debt security that management intends to hold on to until it matures, and management does not intend to sell it for a short term, then it's a available for sale security. Okay? So those are the three categories. Different accounting for each. God bless you. All right. Trading securities. This is your daily get up in the morning, buy and sell stock and bonds. The major difference between this and the other two categories is that any unrealized gains, in other words, the price of the stock has gone up between when you bought it and now the reporting date, the balance sheet date. The price has gone up, but you haven't sold it yet. You haven't cashed out of that investment. You get to take those unrealized gains and losses to the income statement. Because it's your business. That's what you're getting up in the morning to do, for the most part. So you need to report it on the current period's income statement. All right? Subtle change than the other two. And for some reason on this slide, they go into significant influence, and I don't know why. Generally, significant influence, like I told you, that 20% threshold occurs between 20 and 50%. And I'll just mention here, if you get above the 50% threshold, this is something that you're going to be spending a full half of the 8 weeks studying when you get to the graduate course called Advanced Financial Reporting. And that's consolidations. If you have above 50%, or you can exert significant influence, whether it's 15% or 30%, if you can exert significant influence over the target company, the invested company, then you have to consolidate the operation. And the way you do that is you take all the adjusted trial balances for the parent company plus all the subsidiaries in a big long worksheet. You add them all together and you do a whole series of eliminating entries in order to produce one financial statement that you then release to the public. All right? That's consolidation. That generally is above 50%. If it's in between 20 and 50%, it's not a passive investment any longer. And so what you do with that is you report on your income the pro rata share of that subsidiary's income. So for example, you go out and you buy a company and you buy 25% of it. It's not a passive investment anymore. You own a quarter of that company. You put a line item on your income statement, income from XYZ company. And if they earned $1 million in the current period, you report $250,000 of it. It's as simple as that. Okay? Below 20% is what we're going to focus on in this chapter, in whether it's all in the equities, whether it's trading security or available for sale security. So less than 20% is really what the bulk of this chapter is. And that's minority active investments rather than passive investments if it's in between that 20 and 50% threshold. And at that point, you're just pro rata share of all the income. And you do it by flavor. Flavor being you take 20% of their operating income, 20% of their discontinued operations income, or 25%, 25% of any of their extraordinary items. You do it by flavor. So you would have an extraordinary item that says, extraordinary item from tornado loss from XYZ company. And you report that down in that section of the multi-step income statement. All right? All right. So here's just a summary of it. Equity securities, if it's trading, unrealized holding gains and losses goes to net income. Under the available for sale security, it goes to that weird little section in stockholders' equity on the classified balance sheet called other comprehensive income. It's a stockholders' equity entry rather than a net income. It doesn't affect the income statement. Okay? Under debt securities, the trading, once again, any unrealized, so bonds change in price just like stocks do. If they're actively traded on a market, they go up and down. So the bond itself, the premium or the discount that you had on the bond, could change between the time you bought it and the time that you're reporting the fair market value of that investment on your balance sheet. So under trading, if your management's intent is to hold on to that bond just for a short-term period in order to sell it for hopefully a gain, doesn't always work out that way, but hopefully a gain, then you put the unrealized gains to the income statement. All right? Any realized gains across the board, if you actually sell the stock, then of course you recognize the gain and loss at the point of sale. Okay? All right. On held-to-maturity debt, you record it at cost. You then amortize that cost on the ending balance sheet. Because in bonds, you will recall, there are two interest rates that are applicable to a bond issue. One is the interest rate that is actually printed on the face of the bond. And we have a chapter in this course later on long-term debt where we'll be focusing on bonds. And I've actually gone out on eBay and bought a couple of bonds that are, samples so that you can actually see what one looks like. And I'll bring those in. So there's an interest rate. And all that is that the face value of the bond, whether it's $1,000 or $10,000 is the typical increments, multiplied by the face interest rate is the interest check that you're going to receive periodically, whether it's annually, semi-annually, or quarterly. All right? So that's the interest that you're going to receive on the bond. That may or may not be what the market feels is an adequate return on that bond. The market sets what they need for an investment of similar risk. And it fluctuates day to day based upon all the outside. Right now, bonds are up because, well, in the first 2 weeks of the year, bonds were up. Now they're down again. The bonds are very complicated. So that changes. If the interest rate on the face value of the bond is higher than what the market wants, in other words, the market rate is lower than the face rate, what will happen? It will sell at a premium. The market will reward you by giving you more than what the face value of the bond is. So if it's a $10,000 bond, they will buy it from you at $11,000 or $12,000. If it's the other way around, if the market needs more than you're paying, they will penalize you and you will have a discount. Okay? Both that premium or a discount from the moment you buy it has to be amortized using the effective interest rate method, and that's one of the problems that we'll be going over the next couple of days, is how to calculate that over the effective interest rate method that either adds or subtracts from the cash interest that you receive in order for you to report interest income reflective of the market rate, not the face rate. Okay? Does that make sense? All right. So on held to maturity securities, you do not record to the balance sheet or the income statement in the case of a debt security any unrealized gains. So if the bond price fluctuates on a held to maturity security, in other words, it's not a trading security, it's not what you're doing as an active basis, buying and selling, then you just footnote it, you know, the bond price has gone up such and such dollars in the financial statement disclosures. You don't take it to either other comprehensive income or the income statement. And this I already talked about, premiums and interest. So if you buy a $100,000 bond for $99,000, that tells you already, and the way this will be listed in the Wall Street Journal or on the web pages, it'll be listed as a price of 99. So all bond prices are listed as percentages. So if you see a 101, that means 101% of the face value. In this case, 99% of the face value. So they intend to hold them to maturity. So the investment is debited, investment in held to maturity debt securities. The credit is cash. When you receive the interest, you're going to take the interest, the market interest that 99 was based on, that 99 price, and multiply it by the book value. This is known as the effective interest rate, and that's what we'll be doing problems of a similar nature on starting on Thursday. So here's one where there's a premium. So the bond has a face interest rate of 13%. It's semi-annual, so how much are you going to receive in an interest check every 6 months on June 30 and December 31st? What's 13% of $100,000? $13,000. And you're going to receive it in 2 payments. So $6,500 is the cash check that you're going to receive by holding this bond. All right? It's sold at a premium because the market only needed 12% in order to make this investment of similar risk. All right, so the market determined that they only need 12. You're giving me 13. I reward you for your generosity by paying 102 and looks like 4/8. So they're going to give you 102,458. If there's your debit and credit, same investment in held to debt, maturity debt securities, credit cash. When you receive the first interest check on June 30th, you're going to multiply the carrying value, which is the purchase price, times the market rate. And what was the market rate? 12% annually. So how much is it every 6 months? 6%. All right? I'm always going to fight that. I've told most of you that I attended a seminar here on campus that stated that it takes an average college student, if you ask a question, it takes an average college student about 35 seconds to formulate an answer, screw up the courage to actually blurt the answer out. And the average college professor waits about 7 to 10 seconds before answering the darn question themselves and moving on. We all hate silence. So I try to fight that when I ask you something. So 6% is the market rate. So if you multiply that 102,458.71 times 6%, you'll get $6,147.52. That's the interest income for the period. You're receiving $6,500 in cash. So the difference lowers the carrying value of the investment in held to maturity security. All right? Because what does this need to be when you get to the maturity date? How much? No. The premium will be 0, but what will be the carrying value of the investment? 100,000, exactly. So you're going to be chipping away at that premium, which is when you bought it, $2,458. You'll be slowly chipping away at that until that is 0, and you're left with just the maturity value of the bond, which is $100,000. Okay? And that's the way you do it, is this effective interest rate. So what changes is you're going to debit the cash, you'll credit that investment to held to maturity debt securities by the $352.48, and then you'll take to the income statement for that first 6 months the $6,147 in interest income. Okay? So that's a premium. If you had the opposite, if the market needs 14% and you're only paying 13%, then they'll penalize you. They will give you a discount. All right? And actually, you're the one buying. So you have bought it at a discount. And so the effective interest rate now is higher because the discount that you paid gives you more interest income every 6 months than the cash does. Because you needed now 14% in order to make that investment, not 12%. So if you multiply the carrying value of the investment by 7%, which is the market rate for 6 months, then you get the $6,833. You actually received $6,500 in cash, so now you're debiting the investment, slowly, once again, chipping away at that discount on the bond until that, at maturity, goes up to $100,000. Yes, sir.
So you bought the bond at $97,000?
Correct. Because the bond only paid 13% cash interest. You needed 14% to make the investment. That's what the market determined. An investment of similar risk needs to return in order for them to do that. And that fluctuates daily, hourly, while the bonds are trading. Okay? Does everyone understand that one? Because you're going to see the opposite of it next chapter when we talk about long-term debt. So you might as well understand it now so that you can understand this is we're buying. Later we'll talk about we're selling. All right? But the same calculation occurs in both cases. All right? Okay. There's where the entries go. So what do you do if you buy a bond and it's not on either the issue date or the date in which the interest is paid? So here's a $200,000 9% bond that pays on June 30 and December 31st. You're buying it on March 1. So since the last time it paid interest, it has accrued how many months? March 1. So how many months have gone by since December 31st? 2. Thank you. January and February, right? Okay, so the 2 months is going to be built into the purchase price of the bond. So what 2 months worth of interest at 9% for $200,000 is $300,000, and you will pay, assuming that there is no premium or the market rate is 9% also, then your purchase price is going to be $203. And what you do is you debit interest income at the date of purchase, because what that does is drive that into a contra revenue account status, so that when you book the interest that you actually receive, they don't show it. When you book the interest at the end of the $9,000 that you'll get on June 30th, the net interest income between the two entries is going to be the $6,000 that you actually earned, not what the former bondholder earned. Okay? So that's the mechanism we use for between interest dates. What if you sell it? It's the same thing. You sold it for 102. The bonds were purchased with an effective interest rate of 14%. Then the interest that you have earned is going to be built in. The $190.72 is going to be built into the price of the bond when you sell it. So same difference here.
So are you selling the interest with the bond?
You're selling the interest with the bond, exactly. And then once you pull out the interest, you then calculate the gain on the debt. Okay? And problems will, over the next couple days, will clarify that even further. Okay. That's enough for investments in held to maturity. Trading securities. This is you get up in the morning and you buy and sell equity and bonds and all that other stuff. The key difference in this is that any change in fair value goes to the income statement, because this is your business. This is what you do on a daily basis. So you need to report the fruits of your labor, so to speak, on the income statement. So unrealized holding gains and losses are included in net income in the current period. And this is all based upon management's intent, once again. All right? Almost finished. Okay. So initial cost, you've bought a portfolio of 2 types of common stock, 1 preferred stock, and a bond. All right? You paid $68,000 in total based upon their current market price. So the debit is investment in trading securities, the credit is cash. And this was on May 1. So now on December 31st, you have interest receivable on the 1 month of bond interest until such time that it pays. And then when you receive the October, you then get the net of that, because you had bought it mid-period on top of all the other things. All right? So here's your $3,000 dividend from the various stocks. That's just dividend income, debit cash. And then at year end, let me see, where is that? There we go. Okay. At 12/31, that May 1st investment of $68,000 has grown in aggregate. Some have gone up, some have gone down, but in aggregate, it has gone up $3,000. This is a trading portfolio. So that $3,000 goes to unrealized holding gains and losses on trading securities, and that is an income statement account. It's included in your income from continuing operations. All right? That's more than likely another item. Yes?
So whenever you buy, I guess you can say common stock, that's always going to be trading, right?
Yeah, even common, preferred, and bonds are considered trading securities. So,
okay.
Yeah, they're all sold and bought and sold on an active market. Okay? All right. If the investment goes down, the entry is the opposite. It's now a debit because it's now a holding loss rather than a gain, and it lowers net income. And in both cases, you're writing up or down the actual investment account because you're always going to report in the asset side of the balance sheet the current fair market value. And that's across the board, whether it's available for sale security or a trading security. You want to reflect, because these are all highly liquid investments. If it's an actively traded security, you can sell it tomorrow. So the readers of your financial statements need to know what the current fair market value is on these investments. Okay? So now you sold a trading security. You had just got finished writing it up. If you remember, you wrote up at year end, you spent $6,000 on it when you bought it back on May 1st. By year end, it had gone up $100. All right? Then you sold it 2 months later on March 1st for $6,000, which was coincidentally your original investment, but you have already taken that $100 unrealized gain to the income statement. So now when you actually dispose of this investment, you have a loss. So a loss on sale of trading securities. That's different, you'll see here in a second, than how we treat available for sale security, where we're taking the gains and losses to the other comprehensive income. Okay? And then this is the change in the rest of the portfolio, the remaining share of common stocks, and this is an error on the slide. This was a preferred stock, as I recall. So you've now got an unrealized gain at year-end 2014 of $2,400. You do the same thing. You write up the entire portfolio of investment in trading securities by the increase, the unrealized increase in the rest of the portfolio, and you take that to the income statement. Yes, sir?
Never mind, I got it.
Okay, good. I have a question over here, too. No? Okay. Yeah.
Did you buy those before? Like, did all the common stock?
All this was bought in that initial investment of those 4 different securities.
Okay.
Yeah, back on May 1st, 2013.
You don't have to sell it all. Like,
No, you don't have to sell it all anytime. Yeah, you can hold on to it. But by its definition, if it's a trading securities, management's intent was to sell it for a gain. So, I would start, if I was the auditor of this company, I mean, here at the end of 2014, they're a full 22 months into holding on to that stuff. I'd go, is this really a trading security? You've been holding this for darn near 2 years. Because what do you get to do if it's a trading security? You get to take the unrealized gains to the income statement. So at this point in time, I have no doubt the auditors are going, hold on a second, I don't think we need to, you get to take this to the income statement. I think this $2,400 is available for sale securities because you haven't proven to me that management's intent was to sell it. So I would start questioning, it's an example that your textbook came up with, but I'd start questioning really what was their intent when they made this investment. All right, so this is increasing the second year's gain in unrealized gain in trading securities. All right, available for sale. So the important difference here is that gains and losses do not go to the income statement. You do not get to benefit net income from unrealized gains. Only when you sell the stock do you get to take the gain or loss. So when we go back into this same increase, same scenario, we bought all 4 of these back on May 1st, 2013 for $68,000 total. The debit now is investment in available for sale securities rather than investment in trading securities, so that's a very simple change. Still accrue the 1-month interest on the bond that you bought, and the actual interest and the dividends that you receive throughout the year. That's income in both cases, whether it's trading or available for sale. So now when you have the unrealized gain of $3,000, it does not go to the income statement. You put in an allowance for change in fair value of investments. And this unrealized holding gain and loss on available for sale securities goes to the stockholders' equity section of your balance sheet in that little area there for other comprehensive income. Okay? So then, when you sell it, there we go. Well, this is if it was a loss. It's just the opposite. You just change the allowance. We go to the selling. Okay, so on March 1st, when we sell this 100 shares of Able Company that originally cost us $5,000, we have an actual gain of $1,100. And so that is the gain on available for sale, and then we reduce the allowance by what we had, the unrealized portion of it that used to be in that other comprehensive income. Okay? So you've got two entries needed under the available for sale when you actually sell the stock, whereas under a trading security, you just calculated the gain or loss based upon the fair market value as the last balance sheet date. Yes, sir.
So we had an allowance for change of 3,000.
Yeah, in the whole four securities attributable to just Able stock, it was $1,100. So you wipe out what is attributable to that particular stock that you're in fact now selling. All right? Yes? I don't see the furrowed brow, and nobody's shaking their head, so I'm going to move on. Okay. And then if you have, with the remaining shares that you still have in the portfolio, you then take that and adjust the allowance based upon what it now reflects, the $700 change in fair value.
I thought you didn't record it unless you sold it.
No, you record it to that allowance account. You just don't take the unrealized gain to the income statement. You put it in that other comprehensive income on the stockholders' equity section. So it's really what you're doing is, well, in this case, you're increasing the asset side of the long-term investments, and then the other side of it is you're increasing stockholders' equity to keep the balance sheet done. All right. Whereas under trading securities, you're taking the unrealized $2,400 to the income statement, which is increasing retained earnings. So it's just a different, but you don't get to report it on your income statement, which is why I was making that comment that if you had held on to it